Welcome to the Jill on Money podcast. It is Saturday, May 8th. And this weekend, we are talking about the absolutely hot on fire housing market. We've got a great guest. Her name is Maria Fregosi, and she's the Chief Financial Officer and one of the founding executives at a company called Homepoint Financial. This is going to be one of those popular topics that's going to get you to write in and ask questions. Great, do that. Our email address is askjill@jillonmoney.com, askjill@jillonmoney.com. In this first part of our interview, we're talking about the current rate environment and how the cost of building a home is skyrocketing. Here's part one of Maria Fregosi. Tell us what's going on right now in the U.S. economy, everything we need to know. Okay, now maybe not everything, but it seems like we're at a good point. Things are turning. The economy is growing again. So are you feeling optimistic right now?
Yeah, we're certainly feeling optimistic. We're seeing that growth. We're definitely seeing people looking at the purchase market in mortgages and in the home sector. We did see a slight uptick in rates, but it does seem like that's starting to settle in now. Things really seem to be chugging along quite nicely.
Because things are going along pretty well, and it looks like that we're going to have growth of, 6% this year annualized, maybe up to 10%, depending on, who you're talking to, but it's going to be a strong year for growth. Does that mean, or does that put on your radar screen the idea that the Fed is going to increase interest rates as a risk factor?
So it's certainly something that we're watching, but it's not something right now that we're particularly concerned about. They seem pretty intent on making sure that the economy is really stable after everything that happened with the pandemic. So we're not expecting them to really come in and do much with rates. And if they are going to do that, it feels like, in particular, this group will signal that. And we're not seeing them signal that yet.
So they'll really go out, they'll talk about it, and you'll start to probably see longer term interest rates rise ahead of the actual short term rate increase from the Fed. Is that what you're saying?
Yeah, for sure. I mean, you'll definitely see the steepness in the curve start to come back. And that's another thing that we're just not seeing. Long-term rates, we really focus in the mortgage industry on the 10-year. And, the 10-year has been really still very low and relatively stable within a range.
So when you think about these crazy low rates, and, it's so funny because I'll hear from people and they'll say, I refied, but I had to pay as much as 3.25%. I mean, it sort of makes me giggle a little bit. Can you just describe how, historically, where we are in the context of rates?
Oh gosh, historically where we are is still some of the lowest levels that we've seen really in the last 20 years. If you're getting a mortgage with a 3% handle, you're doing really well. And really the difference in a payment on an average mortgage between someone who got in the high twos and where we are in the low threes is just not that much. That is a very attractive rate. It's even attractive for people who are looking to do something like a cash out refi and consolidate other debts because you just can't borrow really anywhere at these type of levels.
Wind the clock back a year. And when you were, let's say, watching the U.S. economy shut down, was it surprising to you how the housing market then picked up? I mean, it seemed to me like I was so shocked. Of course, it made so much sense. It now makes so much sense. But it felt like so quickly people were like, get me the heck out of this small place. I'm going to be home for a while. I mean, the market seemed to have exploded. Did you expect something like that?
So we did not expect that. We really didn't, like everyone, we really didn't know what to expect. But I think part of what actually drove that was how quickly the mortgage industry as a whole was able to react to what had happened. So we very quickly were able to send everyone home, have them work from home, and figure out ways that even in what's still a very physical process to get a mortgage, you have to sign physical paperwork. We figured out how to get that done, a combination of e-signatures. We figured out how to get people's houses appraised, even in the midst of a pandemic. And, the government certainly helped us in a number of places. Fannie and Freddie, who works with us as mortgage originators, they allowed for appraisal waivers. So if your house was, within a certain range, they allowed no appraisal. And that also certainly helped things move along. But yeah, it was a big surprise to us, not only just refinancing, but that purchases really continued to clip along. So, people were continuing to buy houses, it appears, partially online.
How much does the idea that rates are really low, I have to act now, how much do you think that plays into it in general, whether it's a refi or a purchase? Like, I want to hurry up and capture this now. How much can that emotional push lead to an actual transaction?
Oh, I think there's certainly some of that. There's a combination, I think, of that emotional, and we always joke about the cocktail party talk that, someone likes to say that they got a mortgage rate in the twos. So while they were in the twos, it was certainly driving people to make sure they were locking in that interest rate, whether for a refinance or a purchase. And it does seem in the purchase market that there's definitely a flurry, like they don't want to miss this opportunity, which is definitely driving demand.
Now, before the COVID crisis, we did not have a lot of homes that were on the market. We already had an inventory problem. Now, from my understanding, a lot of that inventory problem occurred after the last housing boom and bust, where we had a lot of private equity firms buying up properties, pulling those properties offline. People who were underwater couldn't move, so that we had a sort of a stagnant housing market. So can you talk a little bit about the inventory problems that persisted before COVID and where we are now, a year after the COVID crisis really began?
Yeah, it's interesting because even as you said, right before the COVID crisis, I was certainly talking to other economists out there that were concerned about the inventory problem and had been concerned about the inventory problem, frankly, for years. Especially as it was looking for the first-time home buyer, so getting your first rung on that ladder of home ownership. You're right; the private equity firms were certainly going in and buying up many of the low-cost properties and then putting them into the rental pool. Mm-hmm. And at the same time, you had builders that had been so badly burned by the last go around. A lot of them just simply exited the market. So you had the large builders, but you didn't have a lot of the small builders who regionally play a very important role in creating inventory. So prior to the pandemic, we were probably at about 4 months of inventory, and that's historically really, really low. An equilibrium feeling is more around 8 to 10 months. Well, now we're staring at like 1 month of inventory. And so it's amazing how through the pandemic, now we have very little inventory on the market. And I think it's creating really a vicious circle where why would I put my home on the market? I don't know where I'm going to live. And so people are not putting their homes on the market because there aren't other homes on the market. So something here is going to end up having to break that logjam. And maybe it is the builders, some of the smaller builders coming in, getting tracts of land and starting to build more of that where they can affordable housing.
Even with the builders, I spoke to a home builder that I know, and he is saying that, going out and buying land right now is precarious just because the cost of actually building a home has increased so much. So we know that lumber, very expensive. We know that copper, very expensive. Petroleum products that are used in lots of different parts of the housing construction. All that means that the actual price of building a home, or the cost of building a home, has gone up. Can builders do that and just pass it on to new buyers? Or do you think that there's going to be some relief in the pressures building up in prices?
So we're hoping that at some point there's going to become more of an equilibrium around that supply chain problem. We're hearing that from everywhere. I mean, you talk to anyone who's even trying to do a renovation, they can't get supplies. They can't get plywood. They can't get, some simple materials. So what we may see is it may have to go through the whole chain where, builders end up building some of the larger, more expensive homes, which frees up somebody who's in a starter home to go to their move up home, that will start to create that inventory again. And perhaps it is still people who, after the pandemic, are changing the way they live. So they're either moving out to a place where they can get more land, or they really need that second, third bedroom to create, home offices for, both mom and dad. We'll have to see how that ends up playing out.
Thanks so much for listening. Great first parter. Wait till tomorrow. There's a whole second episode, which is fantastic. If you have a question about your home or something else going on in your financial life, of course, just send us an email. Our email address is askjill@jillonmoney.com. And if you're on our website, don't forget, click the contact button. And that will be your magic journey to us. Don't forget to tell us if you'd like to join us live. Mark will do all the work. We'll just get you on. It's so much better. And I know it's May. It's exciting. People are vaccinated. You feel good. I know. Don't let our guards down. Come on. Wash your hands. Wear those masks if you're inside. And please maintain your physical distancing. Put your hands metaphorically on someone's back. We'll talk to you tomorrow.